The next 72 hours are going to be a massive tell for the United States and global economy for the year 2020 and beyond. Let's get into talking about that. Let's go through what has been happening and why I'm especially paying attention to the next 72 hours, because they could really make or break our investing strategies moving forward. Let's get right into it, because after all, this is news that makes you money. All right, everybody, let's just start with the good old whiteboard. Here's the scoop. Leading up to 2018, in 2017, we had a pretty stable, growing market. Beginning 2018, Trump tax plan incentivizes businesses to sell. Earnings go through the roof, and business spending goes nuts. Things go a little hyper. Well, that hyperness, unfortunately, got a little bit of whiplash from the good old Fed. So if you think the Fed has very little impact into what happens in the marketplace, you're wrong. The same is true for the government, because remember, this was caused by the Trump tax plan, at least in part, pushing up the market pretty substantially at the beginning of 2018. Oh, and a quick note, I'll be in San Francisco on November 16th. I really hope to see you there for an in-person real estate investing crash course. And if you'd like, check out the new courses that are currently in pre-sale in the link down below. Now we have real estate agent sales, real estate investing, teaching you how to get below market transactions, and then we are introducing personal finance and do-it-yourself property management. Which, by the way, the management one's going to be collaborative, so it'll be really fun. Intermission over. What does the Fed do after the bubble at the beginning of 2018? Fed jumps in and aggressively pushes up interest rates and says, you know what, we're bubbling, slam on the brakes. They hit the brakes so darn hard that our market throughout the end of 2018 pretty much went for a free fall. At least in real estate, we saw prices in areas throughout the country drop 8 to 12%. And at the end of the year, we saw the stock market drop somewhere around 10 to 15% as well. Now that led to a pretty crappy end of 2018 end here. And at the beginning of 2019, a lot of us were expecting this is it. This is just the start. 2019 is going to be the year of the recession. You better start saving money because we's all screwed. Well, unfortunately for the people hoping to go shopping at the bottom, and fortunately for everybody else, this didn't really happen. Instead, throughout pretty much all of 2019, we started the year off with a lot more of this. And lately, and this is the big change, the big sort of inflection point, lately, we've actually been seeing much more of this. Obviously, if we zoom in and follow CNBC, the app that'll give you a heart attack with its notifications, you'll see a little bit more of this. But the market has really been interesting because corporate earnings just aren't showing the negativity that a lot of us are feeling or are expecting. We're not seeing as much negativity in the Eurozone. We're seeing positive signs coming out of Brexit. We're seeing positive signs with the China trade war. And even though corporate debts and lower quality companies aren't doing super hot, and we've got things like WeExit going on, WeWork joke, the market's proving to be pretty dang resilient right now. Well, what then should we expect for the market in 2020? Well, this is where the Fed, over the next 72 hours, is going to give us some pretty incredible guidance, but it's not going to be what you expect, because I know a lot of us who say, don't listen to the Fed, what do they know, blah, 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 blah. Okay, fine, whatever. The bottom line is they have the power to affect the market with the expectations they set. So whether or not you like the Fed really doesn't matter. What we're expecting, let's just be very clear here, the expectation is that the Federal Reserve is going to reduce the federal funds rate to the range of 1.5 to 1.75. This will represent another 0.25% drop in the interest rate. This is pretty much priced in, and analysts think this is about 70 to 90% likely to happen. If the Fed does not drop rates, that would be a massive shock to the markets. The markets would not expect that. And the Fed has already indicated that the last thing they want to do is rock the boat and shock people's expectations. So in a weird way, people's expectations could partially be driving the Fed's decision to stay on the course of reducing rates. However, this isn't what matters. What matters is what they're going to say going forward. Now, over the next 3 days, most people are going to pay attention to that October 30th meeting at 2 p.m. Eastern Standard Time, where the Fed says we've decided to drop rates or not. It'd be a big shocker if they didn't drop rates. But what's actually going to be the most important is what they say, which in my opinion will be a huge tell as to what we should expect for the direction of the marketplace in 2020 and whether or not there will be a recession in 2020 at all, or perhaps was what we saw at the end of 2018 our recession. Now, there are three possible things the Fed will say. They'll either say this is the last time that we are dropping rates. This will be bad in the short term for the market. So in the short term, we might see a little bit more of this kind of flattening, possibly a little bit of a decrease. But my expectation is for the rest of the year, we'll probably see more people be excited about the marketplace, and you might see 2020 go right back to 2017 style market. So overall, this would probably be a good thing, but it'll hurt a little bit in the short term, which in my opinion might be a good time to buy stocks. And obviously, don't sue me, bro, if I'm wrong. Although the last time I made a stock market prediction, I said everybody should buy Tesla all day long under my target price of $232. And those people are doing really well right now. The second option is the wait and see approach, and I think this will be the smiley face approach because it's going to sort of keep us on this same trajectory without that sort of short-term uncertainty of the Fed going, that's it, we ain't doing any more. Instead, people want to believe that the Fed will continue to step in if necessary. So wait and see could be the best case scenario. Those are the words we want to hear. If they say something like a combination of 1 and 2, which is quite possible, where they go, this is it for now, but we'll wait and see, what happens in the next 6 months, we might see a little bit of a combination response from the market. The last option is the Fed indicating another drop coming, or if they go for a 0.5% drop this time, which really nobody's expecting, but this would be very bad because it would be a signal that, there's some real serious problems that the Fed is seeing. And I know a lot of people are like, well, I don't care about the Fed. I don't like the Fed. The bottom line is, if they're sad, then you probably should be sad too. Okay? So to me, that would probably indicate some kind of instability in the short term, but longer, 2020, we might see that decline people are looking for unless the Fed and our government, two separate institutions, continue to try to prop up and prevent this recession by spending pre-election and keeping rates as low as possible. So definitely option number 3 is going to hurt the most for those long-run investors. Even though rates will be lower, it'll be a bad sign for long-term growth. My personal expectation is we're going to see something between 1 and 2. And I do believe, at least in planning for this, that I'm not going to see any kind of massive precipitous drop in 2020. Instead, if anything, I'm probably more of this kind of line here, which if you were to put a percentage on this, it'd be somewhere between 1 to 3% growth, maybe 1 to 2% growth. But as usual, I will continue to invest in below market real estate deals, which I teach you how to do in the courses linked below. And so folks, there you have it. I don't know about you, but I'm pretty optimistic, though I will tell you, October 30th at 2 p.m. Eastern Time will be a very fascinating time. I'm very interested to see what happens because it is going to be the signal for what happens in the marketplace in 2020. And if you're not paying attention to it, or if the only thing you're looking at is whether or not rates drop, you're missing the boat. We've got to keep an eye on the verbiage. Thanks so much for watching another Meet Kevin report, and until next time.